On August 2nd, we did something on this channel that most people are terrified to do. We put a number on the board, we laid out a precise technical blueprint for Palantir Technologies, and we told you exactly what was coming, and then Palantir did exactly what we predicted. So the only question left is the one everyone is now screaming in the comments. How high can PLTR actually go from here? Today we are breaking down an absolute masterclass in technical precision and operational excellence. We warned that options traders were dangerously underpricing the upcoming earnings move, and what happened next was nothing short of a historic transfer of wealth. In this video, we will reveal how a coiling chart pattern and a cash flow monster collided head-on to trigger a $3 billion short squeeze that wiped out an entire community of bears in a single afternoon. But more importantly, we are going to look forward. Because while these initial numbers look incredible, there is one hidden metric buried in this earnings report that changes absolutely everything about Palantir's long-term valuation, and most investors have never even heard of it. Now, before we dive in, if you find value in this level of breakdown, do me one quick favor and tap that like button and subscribe. It genuinely helps this channel reach more serious investors, and it costs you absolutely nothing. All right, let's get into it. But before we look at where the stock is heading next, let's review the exact scorecard of what we predicted versus what actually happened on the field. If you followed our channel on August 2nd, you know we didn't just throw out random guesses. We engineered a precise, mathematical technical map. We identified a coiling technical apex near $122, and the stock closed at $123.06 on July 31st, landing right in the heart of our projected wedge. We warned that the options market was heavily underpricing the earnings move with a standard 15.3% implied swing, which established an upper boundary of $148. So what actually happened? The real earnings reaction was a stunning 29.45% single-day surge. We also highlighted two critical pullback support floors at $154 and $151.43. And right on cue, the subsequent pullback landed at an intraday low of $152.70 before launching a 10.3% bounce the very next day. Every single metric we mapped out was hit almost to the penny. So ask yourself, what are the odds of a single technical map being that accurate by pure luck? Almost zero. To understand why this breakout was so incredibly violent, we have to look at the pressure cooker that was building on the chart right before the announcement. Look at just how tightly compressed this chart was. In the days before the earnings call, Palantir was technically trapped. It was coiling tightly inside a suffocating symmetrical triangle, compressed heavily under its 20, 50, and 200-day exponential moving averages. This technical pattern represents a massive war between bulls and bears, where price action gets squeezed tighter and tighter into an apex with nowhere left to go. And when a stock behaves like this, it is quietly storing an immense amount of energy, like a compressed spring waiting for a single catalyst to release it. The market was still treating Palantir like a slow-growth government contractor, completely blind to the immense stored energy building underneath the surface. And when that spring finally released on Tuesday morning, it didn't just pop. It completely shattered Wall Street's expectations. The moment the earnings hit the wire, the stock gapped open on Tuesday morning at $145.15, instantly clearing every single overhead moving average hurdle like they weren't even there. The momentum was so relentless that the stock surged an extraordinary 29.45% in a single session, closing at $162.66. That completely blew past Wall Street's mispriced implied option swing of $148. But here is where experience matters. As professional traders, we know that trees do not grow to the sky. The Daily Relative Strength Index, or RSI, screamed deeply overbought as it rocketed past 82. So we warned our viewers directly, do not chase this vertical spike, because we anticipated an immediate rejection at the $166 major overhead resistance zone. And once again, right on cue, the stock touched an intraday high of $166.08 on August 5th and was instantly rejected, closing lower at $158.43. Now think about that. What are the chances of calling a rejection to within 8 cents? Practically impossible. And yet, there it was. But that is only half the story, because where amateur traders saw a scary drop, our technical model saw a perfect buying opportunity. This is where technical precision becomes highly profitable. After the rejection at $166, profit-taking dragged the stock down to an intraday low of $152.70 on August 6th. And if you remember our blueprint, we advised buying that dip precisely between our $154 breakout support and our $151.43 Fibonacci floor. That support zone held beautifully, acting like an iron trampoline. Buyers stepped in aggressively, launching the stock up over 10% the very next day to close at $172.01. Now, we did experience one minor deviation from our original model, and honesty matters here. We initially projected a consolidation range between $158 and $162. Instead, we got a massive upward deviation, with the stock coiling tightly between $171 and $179, closing the week at $179.94. And why did that happen? Because a massive institutional re-rating had just created a permanent higher floor. But while we were patiently waiting for the stock to pull back to our support levels, we also executed an options trade that generated pure low-risk income. On August 2nd, we highlighted a highly strategic play, selling the August 7th cash-secured puts at a $110 strike price. Why? Because the pre-earnings implied volatility was incredibly bloated, meaning options buyers were paying an absolute fortune for downside protection. We recognized that the market was pricing in a nearly impossible scenario, that Palantir would somehow collapse below $110. But post-earnings, the stock's absolute lowest intraday point was $143.28, miles and miles away from our strike. As a result, those puts expired completely worthless on August 7th, allowing our options traders to pocket 100% of that expensive premium as pure profit. That $110 strike remained a completely safe, unbreakable iron floor. But now we have to ask the real question. What was the actual fundamental catalyst that triggered this historic re-rating in the first place? Because if we dig deeper into the actual numbers, we see that Palantir's operations didn't just beat estimates, they completely demolished the entire bear case. For the second quarter of 2026, revenue skyrocketed an almost unbelievable 93% year-over-year to $1.935 billion, crushing the consensus estimate of $1.812 billion. Adjusted earnings per share came in at 41 cents, beating Wall Street's projections of 34 cents by a massive 46%. And now look closely at this trend line, because this is the part that should stop you in your tracks. This marks Palantir's 9th consecutive quarterly earnings beat, 9 in a row. This is no longer a speculative story. This is a highly predictable, hyper-profitable consistency engine. And the momentum gets even crazier when you look at exactly which segments are driving this hyper-growth. Bears have always claimed that Palantir is far too government-heavy to ever scale, but the data tells a completely different story. Driven by the unrelenting corporate adoption of its artificial intelligence platform, or AIP, US, commercial revenues soared 149% year-over-year to $764 million. That is up 28% sequentially in just one single quarter, with total commercial accounts climbing to 653. But at the very same time, their sovereign AI and defense moat rebounded aggressively. U.S. government business, anchored by their Maven Smart system, rose 90% year-over-year to $809 million. So what you are really looking at here is a dual-engine monopoly, protecting and expanding their market share in both the public and the private sectors simultaneously. Now, high revenue is great, but are they actually turning a real profit, or are they just burning cash to buy all of this growth? This is the hidden metric that changes everything. In the software industry, the Rule of 40 is considered the absolute gold standard of operational health. It states that a company's combined revenue growth rate and profit margin should exceed 40% to be considered elite. Palantir didn't just beat this benchmark, they obliterated it, with an almost unheard-of Rule of 40 score of 155%. This was driven by a GAAP net income of $1.062 billion, representing an elite 55% net margin, and an adjusted free cash flow of $1.22 billion at an incredible 63% margin. And when you combine that with a fortress balance sheet holding $9.2 billion in cash and absolutely zero debt, you realize Palantir has quietly constructed a financial moat that is virtually impenetrable. So let me ask you this. What are the odds of any company below the mega-cap giants posting a Rule of 40 score of 155%? It almost never happens. And yet, despite these frankly godly numbers, there was a massive crowd of short sellers betting heavily on Palantir's demise. And they paid the ultimate price. Going into this earnings call, short sellers had been aggressively piling into the stock, building a massive short interest of 68.07 million shares, representing over 3% of the entire public float. These bears were heavily positioned for multiple compression, betting confidently that the AI hype would finally fade. Instead, the blowout earnings acted like a high-octane spark thrown into a sealed room. The ensuing 30% single-day surge triggered a historic short squeeze, inflicting an estimated $3 billion in mark-to-market paper losses on those short sellers. In a single trading session, the entire year-to-date profits of the short-selling community, worth roughly $2.7 billion, were completely wiped out, forcing massive margin calls and a wave of involuntary panic buying that only pushed the price higher. But even after this absolute bloodbath, one legendary bear is refusing to back down, and he is setting up an even bigger battle. Legendary investor Michael Burry, of Big Short fame, has doubled down on his bearish thesis, reportedly purchasing March 2027 put options struck in the low to mid-100s, betting that Palantir is ultimately headed far lower. Burry points to heavy stock-based compensation dilution, which stood at $265 million in the second quarter. And on the surface, that sounds concerning. But here is the operational reality that the bear case conveniently ignores. Palantir's quarterly free cash flow of $1.22 billion completely dwarfs that dilution. When a company generates well over $1 billion in pure cash every single quarter, with zero debt on the books, a valuation compression short thesis runs headfirst into a cash flow buzzsaw. So could the greatest bear of a generation be wrong again? The numbers certainly seem to think so. And when we look at the actual business developments happening right now, the growth runway only gets longer. Since our last video, three major catalysts have emerged that further solidify Palantir's dominance. First, their new sovereignty bootcamps onboarded nearly 200 organizations in less than 30 days, acting as a wildly efficient, almost viral customer acquisition tool. Second, a new strategic partnership with Mercury Systems integrates Palantir's software directly into U.S. defense manufacturing, backed by a war budget that mandates rapid AI acceleration. And finally, Palantir has successfully embedded cutting-edge models directly into AIP. By remaining completely model-agnostic, Palantir ensures they win no matter which AI provider ultimately dominates the future. In other words, they are becoming the indispensable operating layer of the entire AI revolution. With this kind of massive fundamental momentum, it is honestly no surprise that even the most conservative analysts on Wall Street are throwing in the towel. Wall Street institutions have been forced to aggressively re-rate and upgrade their price targets, almost tripping over each other to do it. Bank of America raised its target to $255, pointing to outcome-based pricing and a rapidly expanding commercial backlog. Citi upgraded its target to $245, stating that these results further weaken the entire bear case around AI competition. Piper Sandler lifted its target to $230. Truist landed at $223. UBS raised to $220, and even Deutsche Bank finally upgraded the stock to a buy, with a $200 target, openly declaring that Palantir is now operating several steps ahead of the entire software sector. The analyst consensus is shifting rapidly, from deep skepticism to outright bullishness, almost overnight. So with the stock currently trading near $180, what is all of this actually worth, and just how much upside is realistically left? Let's look at the quantitative models. If we project the long-term cash flows and factor in Palantir's massive $13.1 billion remaining deal value backlog, the intrinsic value ceiling sits at an impressive $276.40 per share over the next 12 to 18 months. In the medium term, the 12-month target points to $212.42, and in the immediate near term, the technical chart shows that if PLTR can break and sustain above this key $179 resistance level, it will trigger a fresh breakout targeting $183.15, followed by a rapid leg toward $206.95. The math is telling us something powerful here. The growth is not only real, it is actively accelerating. Which brings us to the ultimate question. What is the actual actionable playbook for your money right now? Before we get to that final verdict, a quick and important disclaimer. I am not a financial advisor, and absolutely nothing in this video should be taken as personalized financial advice. Everything shared here is for educational and informational purposes only. All investing carries real risk, including the potential loss of your capital, and past performance never guarantees future results. So please, always do your own thorough research and consider speaking with a licensed professional before making any investment decision. With that said, here is our honest breakdown. If you are a short-term swing trader, exercise extreme caution right now. The daily RSI is currently screaming overbought, sitting between roughly 74.7 and 78. Do not chase this stock at $179. Instead, maintain a disciplined hold and look to add to your positions only on tactical pullbacks into our newly established support zone between $158.33 and $171.04. But if you are a long-term investor, this looks like a high-conviction story. Try to tune out the short-term macro noise, ignore the minor insider trims, and focus instead on that enormous $13.1 billion backlog and the cash compounding machine underneath it, potentially over the next 24 to 36 months. So now I want to turn it over to you, because I genuinely read every single comment. Here is my question. If Palantir pulls back into that support zone tomorrow, are you buying the dip with both hands, or do you think Michael Burry finally gets his moment and the AI trade unwinds from here? Drop your honest answer in the comments below, because I want to see where this community really stands. And if this breakdown brought you real value today, please take 1 second to smash that like button and subscribe so you never miss the next call before it happens. Thank you so much for watching, and I will see you in the very next one.